All right, so welcome once again on our weekly sessions. I think it's very interesting markets. We did talk about the frothiness in the market last week, and we got lucky in terms of correction. And as it always happens in the current market, there is hardly any deeper correction. So we did have a negative week, you can call it. Markets did go down. So let's have a quick look at where we are, and we will then jump into other details. And before we get into more details on the market, let me remind people that we have one of the most awaited events, which is our Investor Day. We do it 3 to 4 times in a year. Mostly event where we do a lot of education, a lot of discussions. And as we have the website up, I think if you've already seen it, and we're going to discuss how we generate these returns, right? We have these products in managed accounts as well as in newsletter model portfolios. This year has been great. I think as we had pretty good years in last few time, but I think this year has been exceptionally great. Where I think one of the best performance. So do come in, and as I was explaining before we started recording, we have some special market mindset workshop this time, and the usual macro and all that education will always be there. Where we are in the how to plan for the next 3 months, 6 months, and 1 year. That's we always talk about those things, but we are doing a roundtable discussions and a lot more of interactive workshop. That's the goal this time based on the feedback we got. So anyway, jumping into that, so do register. I think this weekend is the early bird is finishing, so do register for the event if you are interested and if you're around next weekend. So let's get into the markets. So as I mentioned last Friday, we were just discussing how the markets have turned frothy, how it was looking like overbought situation. And on Monday, we made a new high, which was a pretty positive day. But immediately afterwards, 3 days, Tuesday, Wednesday, Thursday, we have seen reasonable amount of correction. I would say in today's market, as we previously discussed, none of the corrections stick. And very similar thing, I think Friday, today, we actually recovered half of the losses from this week. So I think this is typical of current, I would say liquidity situation where market is. And what happened? What triggered it? I think we did share in our WhatsApp channel also. Today, the recovery triggered from the PCE numbers, where the inflation, which was a kind of worry sign for most of the people, came out almost in line, no negative surprises. And what does it mean? What that means is the biggest panic around tariffs is not playing out, even though inflation is not coming down. But the easy money policy will continue because the PCE not heating up. And what it also means is we get these numbers once in a month, right? So the point here is if you are not going to get another negative surprise for another month, and we already have 88% or 90% probability of another rate cut in October. So we are basically looking at no major macro negative news. And that's what I think the market celebrated today. On the other hand, as we were already overbought, so there was some correction, especially in tech stocks. I would say NASDAQ had a little bigger hit in terms of points, you can say. And that is obvious because NASDAQ was even more overbought. As we were highlighting last week, that the number of positive days back to back, this like if you understand how these candles work, if they are green, that means it was a positive day. And if you look back over 3 months, 6 months, you will never see such a huge run up. So this is more of a technical correction, I would say, what happened this week. Forget about the news or anything, it was due. But Nasdaq did make a new high, and as we saw today, just a single positive news, this correction did not stick, and we had a expiry day recovery, which almost cleaned up half of the losses from this week. So I would say great end of the week. While whether this correction continues, usually we always say that the previous all-time highs are great support, and if you should test it technically, that is, and remember, we are way away from the mean, as you say, right? We call it reverse to the mean when somebody tests 200 moving average. So as long as we are still way above 200 moving average, we can have a huge correction, maybe 10% correction, and we will still be in a bull market. So be ready for those in a, from a planning perspective. But I think at this moment, we are just enjoying this good tailwinds from a macro perspective. Another thing which I think we were worried about is, of course, the US 10-year yields as the short-term rates are coming down. But if you see, this was again a technical falling back to this trend line. This trend line I had drawn maybe almost a month back or maybe 5 weeks back. I did not touch it. So if you see, we perfectly tested those last 2 days, and we are again cooling down. So nothing to worry about. And even if it happens, if as we discussed multiple times, we have a much bigger downturn at play. You are seeing the US, the peak yields happened in January earlier this year when Trump came into power. And since then, I think they have been talking about 10-year being their priority. If you talk about Scott Bessent or everybody, their goal has been that we want to keep 10-year down. So they have been successful. We have talked about it multiple times. And not only that, in recent times, it's even steepening as we have done with these trend lines. So even if we break out here, I would say we have a lot of other technical support levels where the yields can reverse again. So overall, what does it mean? It means that the short-term rates are coming down, long-term rates are not going up. The PCE data helped where it did not start heating up again. So overall, the tailwinds remain while the overbought situation was somewhat relieved this week. So that again helps the market. So overall, what we're saying here is there was stress in terms of the technical overbought condition, which is kind of released, or we released some pressure, as we call it in layman term. We released some pressure, and now we are ready to make a next move up. Other thing which is we always track is gold, which has been the which is tracking the money supply much better than any other asset right now, mainly because of the sovereign buying, because of the deglobalization of the world. As you see, more and more countries like China and so on are considering moving out of USD as much as possible because of the Trump's rhetoric around this whole discussion around protectionism, tariffs, and so on. So this is more of a breakout play after we have been talking about it, and it's continuing. And as we discussed, I think a couple of weeks back or maybe recently, silver is catching up now, which is usually a late entrant into gold rally, and silver has been lagging. And this means the precious metals are doing great. And if you're part of All Access, you have seen some of our plays like which we have been invested in. They are doing very well. So, but I think overall, again, this is a stretched run up. We do expect some correction, so we are recommending hedging and so on. But overall, I would say we are in a great multi-asset bull market. Bitcoin, I would say, is still under stress, still consolidating. And this is where I think we are watching very carefully. It did have a breakout, as we discussed last week. It was kind of a reversal, but it did not stick again. A lot of supplies coming in at these levels. So I think, on the other hand, it's not breaking down either from the flag which it had formed. So it's more of a sideways movement, we can call it, in a band. And it will be interesting to see. One thing is there is a lot of discussion around 4-year cycle of Bitcoin. We are in the last year of the bull run by that historic 4-year cycle, which is usually correlated with what happens with the halving. On the other hand, there's a theory around halving doesn't matter anymore, because originally halving mattered because it was about the supply being reduced. But on the other hand, with the digital asset treasury companies, with ETFs coming into it in this cycle, people are talking about nobody's really selling. Even the miners are not selling Bitcoin. So halving is irrelevant if there is enough demand. So this will be interesting to see how it pans out later this year. But I think definitely from a bigger picture perspective, this is I would say, underperforming asset in last few months, while it had actually, it was doing much better earlier. So in a bigger picture perspective, probably Bitcoin is still outperforming this year. On the other hand, in short term, it is underperforming. So this is where we are seeing the decorrelation with gold, decorrelation with SPX, which is continuing to work. I think in old days, we used to say, right, that it's very much acting like a tech stock. I think it's right now acting pretty different from all the NASDAQ and S&P 500. So what are the triggers? I think we did talk about this, and we are going to look for. So what to watch out in future? I would say continue to look at inflation number. The good news is the last month inflation is behind us. We'll continue to watch out the yields, because this is where the smart money is going to give you early danger signs of any heating up of economy. On the other hand, with unemployment numbers already being high, so I don't think that is a concern for anybody. So we are still waiting for the rate cuts. We are still watching how the yields play out. And of course, we are near end of the quarter. So by next month, around this time, you will have a lot of earnings. That is what would again drive the whole AI rally, which we wanted to take up as a next topic. So what are the other things, right? So ultimately, NVIDIA is the bellwether. It has been consolidating because it did not rally after earnings. It has been, because usually it rallies at the hyperscalers earnings when most of the news is already in. So NVIDIA earnings come out a month later. So what will happen next is all these Amazon, Microsoft, and Meta of the world, who are spending a lot on AI, they will start reporting next month. and that's where we get to see whether market reacts positively to that or not. And from that context, I would like to just quickly show that this is the forecasts are still not changing. We are still looking at continued spending all the way up to 2030, which is kind of what analysts are seeing. So there is no real reason at this moment. Nobody is predicting that AI is towards in the later stage. Everybody's saying we are in the middle of the expansion cycle. The forecasts are still going up when we look at Meta, Microsoft, Amazon, Alphabet, and then we have all this news around the OpenAI investment from NVIDIA. There is this whole Oracle announcing a huge amount of orders and so on. So it's basically what we are seeing right now is that we have talked multiple times. It's an AI-led rally. There is no reason for it to cool down till, and plus as we talked about the macro picture, when we are seeing that the rates are coming down, so ultimately the money will chase the risk assets. When they're chasing risk assets, which is the biggest trend? It is the AI trend. So I think overall what we are seeing is there is no reason at this moment for people to worry about it. Of course, it can change anytime. Of course, there are we have to look at inflation data on a regular basis. We have to look at where the macro policy will be. At this moment, I think based on Powell going out of who is more hawkish, and we are expecting a dovish Fed chair coming with his term ending next year. So people are very positive about it. One thing I would like to highlight though is stock market always run up looking at the future. So even if the macro, all these things are getting priced in already. When you look at SPX and Nasdaq making new highs, so while yes, the macro tailwinds are there, they remember that stock market will look at any sign even 6 months down the line or 12 months down the line and start correcting first. The real data does not need to change. So that is one thing which people always forget because the news always talks about the commentary on what is happening today, while the investors are always looking at what is going to happen 12 months down the line. So that is one thing I always remind people. And so just make sure that you understand that picture. So let's take a few questions. And I think a few more people came in. So just a reminder about the Proflex Investor Day, because I'm saying it again and again because a lot of people tell me later that we missed out. So just wanted to make sure that you're aware of the October 5th, and do check out our website and more details there if you have. And in the meantime, please feel free to put in any questions here. So I don't see any questions yet in the chat. If you have anything, you can feel free to unmute. I see something coming in now. So how about the data center investment from XAI and Apple, etc.? So totals are actually higher. That's a fair point. I would say right now, because XAI is not a public company, they don't report much of the data. Is mostly speculations or some tweets from Elon Musk. So which is why the analysts don't have a very clear picture, or let's put it this way, they don't have very accurate picture to put numbers in. But that's right. I think XAI is becoming a big competitor of OpenAI. And but ultimately, I think what happens there is that these data centers are still going to probably be expanding across the board, like not just XAI, I would say. Even when I look at some of these NVIDIA's pitches, like when Jensen is going to go on a trip with Trump to Saudi Arabia or Europe, there are a lot of other unknown things where people are going to spend. There's a FOMO right now around whether we are missing out this AI craze. And plus, because of the data security concern and deglobalization, a lot of people are worried about why should I use US companies or US hyperscalers to host my data? So you will see this whole insecurity about their data, about the data privacy. All this will create even bigger opportunity beyond just US companies. So you're right. I think XAI and Apple, I'm not very big on because they are not really spending because they are a public company. We do see that they have decided not to put a lot of money into infrastructure. They are focusing on their strengths, which is their distribution. They are going to probably do a deal with OpenAI or Google or something. Now that they have also won the antitrust case, or it has come in their favor, where they don't have any problems making some deals on this thing. I would say Apple is probably not a big factor right now in the AI spending, but yes, XAI is. And not just that, I would say there are individual sovereign funds are coming in. And you will see Middle East creating their own data centers. You will see Europe creating their own data centers. There is a discussion about like India, Reliance creating data center. China is a lost market. China was a huge market, but I think with all the political and tariff-related fights, I think that is one reason why NVIDIA is actually not at $200 already, as you can imagine. So I think that is where most of the negativity came in last few months, right? Since the first of all, U.S. government banned it, then they said yes, we are going to allow it, and now China is saying that nobody should buy NVIDIA. So this is becoming a more of a negotiation tool, and but also this tells you that how strong the AI tailwind is. That even with a big market like China not there, even just by US and Western markets, we are seeing a pretty good growth in the AI spending. So we are basically seeing a once in a lifetime kind of a boom in spending in US. So I think this is what is playing out right now. So let me take another question here, which maybe let me first take the next one, which is related. It's the AI story being intact. What about the OpenAI revenue? So let me not comment on specific investment opportunities here because we are mostly looking at macro. But overall, I think OpenAI is the leader because they were the first on the market, and I know there is a lot of support behind them from institutions. But I would say it is for the health of the AI market. Ideally, we would like to see more and more competitors, and not one kind of a big leader. But I think let's see. I think let me not comment on that because it's not something which impacts the macro. Overall, I think whether it's OpenAI success or XAI success, AI will make progress. I think the bigger question, which we are also discussing, if you are part of All Access, we talk about in Growth Gadget. The bigger thing is the next level winners, right? NVIDIA was very obvious. All these things were the first level story of spending. But when all these people, smart people, are spending money, what is the next level winners, right? Means we already saw how Palantir is growing. We already saw how Meta is really benefiting from it. We are seeing Google now recovering. So this is where I think as investors we should look at, right? What are the impact on the real world use cases? What is the impact on how these revenues get impacted? OpenAI, unfortunately, is not even a listed company, so it's very difficult for most of the people. And usually in the private equity world, as you know, these things are very bloated, so it's very difficult to even define those. Let me take some other questions now. There's a few other related questions. What's the outlook on residential real estate growth compared to stock market growth? I would say US, so this is a very good question in terms of asset classes. US has been, I would say the real estate was pretty heated up since COVID for multiple reasons. I would say one was, of course, we entered COVID, a lot of stimulus, a lot of free money, and at that time the rates were almost zero, and even the long-term rates were very low. So I don't think we have cleaned up all that, even though the slowdown in last few years have done it. So I'm still skeptical of the real estate revival because even after the rate cuts, you are still at very high rates, and without the leverage, real estate is suffering. So I don't think it's going to be easy for it, but of course the easing cycle is useful for it because the rates are not 7 or 8% anymore. Probably will come down to 4 to 6% more reasonable rates. But I think it's not really a big stimulus at this moment. So let's see how that evolves. But I would say if we believe the Trump administration, who is looking for another 100 basis point rate cuts, that would be interesting how it evolves, because at this moment it's still a theory. Market is still expecting only another, I would say, 75 to 100 basis point, not a 200 basis point which Trump is talking about. And I did discuss last few calls that the biggest, I would say, unknown and biggest blue sky item is, can AI and robotics, can they really create a deflationary cycle in next 5 to 10 years, which is what iPhones created, or what the cloud technology created, where everything was becoming cheaper, when Ubers came into the world, when Amazon grew. That was a huge deflationary force in the last decade. Can we relive through that and get to low rates? That would really define the real estate revival, I would say. Right now, I would say we are still in a restrictive environment, even after the rate cuts, for real estate perspective. All right, so let's take some other questions. We are talking about the job data and corrective action being taken. If interest rate cut is not adequate, is stock market expected to go into recession? So I think this we have covered a few times, so let me repeat that. To be frank, we are actually in recession for quite a few years if you take the AI out. So most of what you saw, because we are in tech world, we invest in tech world, most of the attention is taken by the Mag 7, which is going through a AI kind of expansion cycle. it's kind of unfortunate that most of like there are some trickle down effect in construction side and because of the data centers, because of some additional trickle down effects, but 80% of the other economy has been struggling in last few years. And I strongly believe that if AI boom did not happen, or let's put it in very simple terms, if ChatGPT did not happen right around that time when rate cuts were also starting, probably we would have been gone through a recession cycle. Probably we would have already cut rates way earlier. I would say that AI has saved U.S. economy. If you compare Europe economy or some China, you will see that all of them, when they went through tightening, they all actually went through somewhat of a recession. They are actually even more aggressively cutting rates. And I think US has escaped it from a GDP perspective, at a market perspective. So when you say stock market recession, I don't think that is going to happen anymore, because we have already used this tight period to grow using AI spending. And in future now we are going towards even better conditions. Secondly, we are seeing a very pro-growth administration where they did the tax cuts. They are doing now the SLR relaxation. Yeah, we can always talk about how it will create a bubble in future, but in short term, there's a lot of stimulus coming in that sense. And plus the tariffs which are coming in, the only risk was the inflation, which is not materializing. And as Powell explained it, most of these tariff hikes are being absorbed right now, the middleman, by the somebody as a seller. So it's not really affecting the consumer. So probably it's a great cleansing after the 2020 stimulus and all the price hikes. So it will be very interesting to see how that evolves. But I think next 3 to 6 months, this cycle is only going to help the stock market. The question is whether, as I said, whether the AI spending can continue. Can the other industries come back now when the AI slows down? It will be a very good result for overall market, because all the other industries were struggling. And as we just discussed, real estate is getting kind of a, it was almost dying, and it's getting a little bit of breather with little lower rate. It may not revive to the 2021, 2022 cycle, but it can at least stop dying, which was happening in last 1 or 2 years. You can have the construction starting again. You can have the companies which rely on borrowed capital. They can probably start borrowing again with the lower rates. So I think it will be interesting to see how that pans out. So I think, but remember that this whole easing cycle takes 6 to 8 months to even play out, because economy is a very big thing. It's like you're turning a very big vehicle from one direction to another. It's not like you can do it very fast. So I'm glad that I think Fed is starting to cut rates. I would say this was something which I also believe that it was too late because of the rest of the market slowdown, which is not reflected in stock market only because of Max 7. And this is why I keep highlighting you should look at wider indices like IWM. Before this rate cycle started again, IWM was not even at a 2021 highs. Like, we were still not making new all-time highs on the wider indices, while we had gone 3x on tech stocks in since last cycle. So there was this whole inequality in the market, which I think is correcting now. So probably I don't think it's a big issue now. In fact, easing cycle should help. What is going to how it will work on this in terms of broader economy perspective. But again, as I said, nothing taken away from AI, because ultimately that is the biggest vehicle of growth right now. So ultimately AI will drive it. Whether other industries catch up and pump the rest of the market, that will be interesting to see. And we can go from there on a month-to-month basis. I would say we are watching on what parameters look bad or what parameters look good. So there is no absolute predictions of what will happen, because things change very fast in the world. And as I always say, right, you should never make up your mind about whether we are at top or bottom, because from a stock market perspective, you don't know when the things change. And to be frank, nobody knows. As I'm not going to predict it. And if somebody's predicting where the market is heading, they are just fooling you or fooling themselves. All right, so I do see a couple of other questions about crypto, and I would say recommendations. Unfortunately, we cannot do that. This is a more of an open call. So we do, if you are part of All Access, we already have recommendations. We have our model portfolios and so on, so you can check those. In terms of how aggressive we should be on crypto, again, it's a very personal thing. I believe, like if you are part of our portfolio solutions, you already seen that we believe why we believe something, or we have shared those ideas. But crypto is can be divided into two segments. Let me put it at a macro level. At a macro level, crypto is basically either Bitcoin, which is more acting like a commodity now, which is actually doing pretty well, and gold is showing you the way that how commodities are helped, or on pure commodity, which I have, like Bitcoin has no earnings to deliver every quarter. Bitcoin has nothing going to change in Bitcoin world. It's all about money supply. It's all about adoption. It's all about what people, how much of money allocation come into the picture. So I would say Bitcoin is a easier product to understand for if you are as an investor, because it's purely you can model it based on 70 or 80 years of history of gold. Why I say 70, 80? Because gold is thousands of years old, but 70, 80 years I'm saying because that's when it became a product, as a financial instrument on Wall Street. And especially in the last 25 years, because the Bitcoin ETF just launched last year. You may not know the gold ETF launched maybe like 24 years ago, 25 years ago. So I think that's very relevant history for Bitcoin, because it is the story is digital gold. Now, when you say crypto, unfortunately, rest of the crypto is wild west, other than Bitcoin, because it's not a commodity. It is more of a platform-based play. There are coins, and we have discussed multiple times. Maybe you can watch a month or two ago. We on our YouTube channel on the same calls, we have discussed enough about those. So I'm not going to repeat it, but I think that's where one has to be careful, more careful. I think Bitcoin is more of a long-term play, very similar to gold, and that's how we play it. And second thing which I would always say is being aggressive comes with there's no real reason to be aggressive on anything other than your own risk profile. um, if somebody is trying to sell you that, oh, this is the great opportunity, buy it now, and you will get 25%, that is basically gambling. That's not investment. So what we believe in is that even if you're aggressive, you have to always hedge it. That's how we work it. Of course, there are opportunities when things are cheaper, when things are more expensive, and that's what we do in all access. But when we look at managed portfolio, when we do manage bigger money, right, when we are doing institutional level planning for a consistent returns, you have to always plan for a downside. So when you say aggressive, it's a very loaded question. I don't think anybody should be aggressive without having a hedging plan, without having a downside plan, because even at the best of the best moments, you can be wrong. So just keep that in mind when you're planning aggressive strategies. And again, going back to the original intent of the question, if you're talking about allocation wise aggressive, how much allocation you should have in crypto versus rest, it's a very personal thing. You can make money on Nvidia or you can make money on Bitcoin. Ultimately, if you are going to sell it, it will be your gains in dollars, right? So it doesn't matter how you make money. So I don't think there is a universal answer to it. Everybody is looking at growing their net worth in USD, and these are all vehicles. So don't get too attached to crypto versus Max 7 versus gold. All these are just, ultimately, these are means to achieve something. And you need to figure out what you understand, what you are comfortable with, if you're making your own decisions. And if you are under any of our managed products, we can always guide you in a more responsible manner under a fiduciary duty. But unfortunately, on this call, I cannot talk through those things. But these are good questions, I think, at least. And as I said, right, means if you are, we do cover a lot of these things in our event when you come in. Like, I really believe in mental models of investors, which are the biggest issue in education. You can get a lot of data. Like, what I believe is most of the information sources, whether it's internet, whether it's analyst reports, or whether it is CNBC of the world or Bloomberg of the world, what they do is they throw you a lot of data at you. My goal is when we do these events or when we do any of our products, whether it's all access, whether it is anything we are educating people about, it's the only thing missing in this world of education is mental models. How do you use all this data in your favor? How do you improve your odds of beating the markets? And that's all differentiate between a good investor versus bad. There is no special sauce. There is no real asymmetric information I have, or even the best of the best JP Morgan have, or Citibank have, or anybody big bankers. Trust me, in the today's world of information, you have the same edge as any big banker. You can pay for it, like we pay for it, like in our products, we spend a lot of money, like in hundreds of thousands of dollars of buying information. Problem is not about not having that available. I mean, I can give you that information, or anybody else can give you, Twitter can give you, or CNBC can give you. It's about, can you create a mental model of making money at a portfolio level? You can always make a great trade using an information, but if you made a 50% up trade on a 5% of your portfolio, you still got a 2.5% across the portfolio. Well, that is not beating S&P 500 over the rest of the year. So you need to keep finding these trades, or you need to create a structure or a plan where you can really deliver across your portfolio. So these are, I think, great like discussions we have usually in these events. So would love to for you guys to come in and give us feedback. And we have been learning from all these questions, and we are improving our events and workshops. So would love to see how it pans out this time. I do see another question here about the workshops. In the workshop, can you talk about a big drawdown scenario? How do we continue? Oh, I think this is a great question. And I think not just about drawdowns. I would say what we discuss and I would like people to understand is not worrying about market at all. Like the biggest part about investing money, and especially when your portfolio sizes become bigger and bigger, and of course, all of us are doing great. I think everybody, we are in Bay Area, land of opportunity. A lot of people have made big in their career. They have decent sized portfolios. It's not just about drawdowns which worry you, but also sometimes you miss out on the upside. Because as I always say, if the money supply is growing 8 year per year across the world, and if your income is, your investments are not earning better than 8%, you are still going down the ladder, even if you, whatever money you have earned already. Because it's money is relative. It's very, very simple thing in economics. The resources are going to be the same, and if your money is less than the person next to you, you will be able to afford less. So I talk about two things, and we want to focus this on workshop. Is your goal is not to just protect your capital, which is of course the primary thing, but also how to build a model, mental model, where you can earn returns at a better than the average returns, better than S&P 500, better than anything. And that's what we have excelled in. We have been doing it year after year. And trust me, I know that there's a lot of this average understanding of the market, that it's impossible to do this. And I always laugh at it. And I used to be a little too, I would say, arrogant about it, but I do understand why people do that. But to be frank, it's just a matter of when people gambling versus people making a plan. And it's not about special information, special strategy. It's all about mental models. It's about starting with a plan and ending with a plan. It's nothing to do with, you don't need to do any special, meme stocks, or, I mean, we are just pulled in by this craze of GME, or craze of a crypto, or a craze. Like, I know it's very easy to get into FOMO that one trade, if I miss, I will not make as much money as the other guy. But in reality, you can take the most boring asset class. If you make a plan around it, you can make way more money than other. And one idea I would tell you right now, which we will dig deeper into it, is if you figure out, if you want to make 20% per year, if you break it down into per week how much you need to make and compound it, you will realize that it is fraction of a percent, very, very small percent of money you need to make. So you don't need 10% per week kind of trades. All you need is a consistently making 0.25% per week or 0.1% per week. And that is I think the missing mental model for most of the people. And that does not need you to take risks. That does not need you to rely on market going up or down. So drawdowns and all these things are more of a short-term thing. What we believe in is building a model where you have a plan for generating income using a plan which you can control over a longer period of time, not for 1 week, 1 month, but for years, 1 year, 2 year, 3 year down the line. Because unfortunately, all the other ways you can use to make money, that will not be consistent. If you can, yes, in all access, we always find a great entry, we do great trades. Those are great, but in isolation, the feedback I'm getting, and because we are talking to a lot of retail investors who use our recommendations, that their portfolio still does not do as good as our model portfolio, because they just can't follow the model portfolio easily. And I can understand that, because it's a lot to do with not with the recommendation or trades, because trades will be successful whether you were able to generate your net portfolio returns. That needs totally different kind of skills. And that's what I think when we are managing, it's easy for us because we can do it in a very methodical manner for you in managed portfolios. But when you do it yourself, unfortunately, a lot of variables come into mix. And this is the feedback I'm collecting. And this time we are going to cover a little bit of that in the workshop of how to create a mental model, how to create allocation models, and most importantly, how to think about investing, right? It cannot be just trades. It has to be a portfolio level return. So that's the goal. And I think, yes, we will cover drawdown scenarios, but in the context of not caring about the market, in the context of drawdowns are going to happen, but it only hurts you. And in short, let me put it this way. In short, it hurts you only if you did not have a plan and you don't know how to recover from it. And the third thing is, if you needed that cash on a specific date, and that nobody can save you if the drawdown happens. So all those things we will talk about, like what are the scenarios where it does not work, certain strategy, and how to evaluate. So let me put it this way: how to evaluate a strategy, how do you put in a certain capital into a certain strategy, and what is the right way to think. That's my goal with this time with the workshop, in terms of creating a mental model around it. So I don't know if I answered the question, but yeah, that is the goal. So coming back to guys, so I need to run today. So let me put it this way that, so going back to the market, so just as a summary, let me repeat it. We did talk about it last week. So do watch the video from last week where we talked about why the market is frothy, what is going on. At a medium to long-term level, as we discussed, the AI spending and the AI boom is still continuing. The macro tailwind is still there in terms of the rate cuts. So there's nothing to worry about. On the other hand, don't FOMO into it without having a plan, because as we saw this week, when you are overbought, when market has already run up, there will always be corrections. It's a value trap, right? So somebody telling you it's a value has no meaning, or somebody telling you it's overvalued has no meaning, because you don't know how overvalued stock can become and how undervalued stock can become. So it's all about making a plan. That's a summary of the market today. And knowing that the macro is telling you medium to long-term picture. The medium to long-term picture is looking great for US stocks. In short term, yes, we can have corrections. So make a plan around it. And secondly, as I said, do consider joining our workshop, because we are going to do a lot more of these kind of discussions on October 5th. And this is one of our biggest event this time. Again, means as our community is growing, even as so many days ago, we are seeing that the number of tickets sold and so on are way higher than usual. So we are going to see much bigger event this time. And we are looking forward to get that feedback, and most importantly, learning from others, right? What I'm glad about is, since some of the people who are in our community who have been there for multiple years, when I hear their personal stories, how they have improved in their investments using our education, that's very satisfying for us. And you can also learn from each other. It's not just about me speaking. And this time we are also expanding the networking part. We are also expanding the interactive discussions on a roundtable with the smaller groups. So that's what we are going to create. So it's a very exciting agenda. So do consider bringing your friends who might be struggling with their finances or making questions. As you know, that our goal is purely education in this event. And of course, a lot of you have shown interest in our new product, which is Embark. And I think that is gaining ground in last 10 days, even though it's still yet to, I think we are just preparing the final documents for that. If you're interested, do book a session, and we are going to cover a lot more in event also about that. Just as a summary for those who are uninitiated, that is for people who are looking for fixed income plus growth in a single product. And the goal there is also to help those. I keep hearing this whole challenges of, especially in Bay Area, that you have a appreciated stock, which is you are sitting on. You have a great, your salary doesn't cover your mortgage. Your stock is, you have to sell to enjoy it, and there's a huge tax liability. All these problems we have taken into account while designing this new product. And we are very excited about where this is heading. And a lot of people are showing interest including institutional and retail. And we are going to talk a lot more about this innovative ideas which we are building. It's using the same engine of Proflex, which we have been using from option side. And we are going to share, even if you are not the right person for these products, we will share the learnings, what we have from people like you. I mean, all of you have similar situations somewhere or other, being in Bay Area. So we have accumulated a lot of good to do things for people who are in these situations. So we will talk through that, even though we are not qualified to be tax advisor or something, but we will be sharing the, I would say, good principles, good practices on how to handle your specific situations. So I'm looking forward to that as well, because it's, for me also, it's a learning curve as we are learning different retail market situations, how people are managing their money and what challenges they're facing. And our goal is purely to define products which we can help solve those individual situations. So that is one thing which we are very excited about, and we are actually getting a lot of interest right now. So do feel free to ask for that information from one of the admins, and we can get back to you on more details. And also we will have a session on that in our event. So maybe I can take one or two last questions, because as I said, I need to get somewhere today, so I will not be able to stay till 5. So feel free to unmute, and I can probably stop recording if you want to talk at that moment. Just give me a second.